Well, stocks rallied for a second consecutive day as investors try to shake off fears of tariffs and an economic slowdown. Joining us now, Mohamed El-Erian, Chief Economic Advisor at Allianz. Mohamed, always good to see you. So consumer sentiment quickly deteriorating. Growth forecasts you predict will be revised downward over the next few weeks. Is that going to make this stock rebound hard to sustain, or do you think maybe it's priced in?
So I think it's mostly priced in, John, and thanks for having me. You know, we had two distinct stages to what was the fifth fastest correction since World War II. The first one was a good old growth scare. Then we had pretty nasty technicals, with fast money in particular getting out of very crowded positions. Most of the bad technicals are behind us. So the two questions going forward is, will the growth scare be contained? And will the hope in the Fed put prove realistic or not?
So how important is the Fed on Wednesday to this rally? Any sense we can get from the dot plot or elsewhere of how likely they are to factor tariff effects into their willingness to cut?
So it's pretty tricky because I've also got to deal with the inflation concerns. You know, the survey data, and this is soft data, John, I want to stress, this is soft data. But the survey data points both to weaker activity and higher inflation. And it's that second element that I suspect the Fed will worry about a lot. So, you know, the hope is they keep that two cuts. They don't go to one. That's where the market is. The market is hoping for two right now. And the market is going to be looking very carefully at the language they use to describe the price dynamics.
Mohamed, we've seen consumer confidence fall. We've seen inflation expectations rise. Is the risk of stagflation real here, or given some of the readings we've gotten recently on inflation and given the fact that the tariff situation continues to evolve and change, and we know is only one piece of a bigger puzzle that's also going to include tax policy reform and deregulation, among other things, is that risk overblown? So,
Morgan, I call it a whiff of stagflation. It's not real stagflation, it's a whiff of stagflation because of exactly what you mentioned. So what should we worry about? Anything that takes growth down near 1%. For me, 1% is stall speed. And if we get near stall speed, that will be of concern. So look at the household sector. Hopefully, they will have some confidence in their income stream because that's the only thing keeping them going right now. And businesses have to contain their wait-and-see attitude. The inflation side is more tricky, because we are seeing a significant surge in inflation expectations. These are big jumps that have occurred over the last few weeks. So that one is trickier because can you really get that inflation if the economy softens? That's the big question mark.
OECD forecast out today basically saying Trump's tariff hikes are going to drag down growth in Canada, Mexico, the U.S., drive up inflation. The OECD is cutting its global economic outlook. It's warning of a broader trade war here, given the dynamics we're seeing as well. We've been having a lot of conversations about the fact that the dollar's been weakening against other major currencies. Crude oil has come off. Yields have been under pressure here. Do you invest in the U.S. or do you invest elsewhere right now, and why?
So first on the OECD, I thought the most surprising thing about the OECD is what it did to U.S. growth projection of next year. So it didn't surprise me they reduced this year, but they really took down next year to 1.6%. That is a surprise to me, that they're not saying this is just a bumpy journey. They're saying, you know what, this journey is going to be quite long. And other people haven't gone there yet. That's what I found surprising. Look, yeah, I mean, the U.S. retains its advantages. There's a big debate going on, which is at the end of all this, DOGE, tariffs, at the deregulation, at the end of all this, are we going to sharpen our edge or are we going to erode our edge? And the jury is 50-50 on this. But there's no doubt that right now we still have significant structural advantage. I think that people are getting carried away about Europe, and China is still stuck in this muddled middle. So the U.S. may not be as pristine as it was earlier in terms of an investment thesis, but it still dominates, in my mind, the others.